I'm going to show you how to lose $127,000 in retirement savings. And you know what's even more crazy? Your bank will smile at you while it happens. They will shake your hand, congratulate you on being smart with your money, and watch you make this mistake year after year. And I know this because I have filed over 500 tax returns in the last 2 years. And I keep seeing the same pattern, same mistake. The young professionals, immigrants in their 20s and their 30s, all are making the exact same RRSP mistake. And here's what makes me angry. Their bank knew, their advisors sitting across from them knew, but they signed them up anyway. I'm going to break down the real math, show you the actual numbers, and by the end of this video, you're either going to be really happy that you found my YouTube channel or you really be angry at your bank. So let's get into it. What's up everyone, welcome back to the channel. If you're new here, let me introduce myself properly. My name is Charan, I have a bachelor degree in accounting, I have filed over 500 tax returns, and I have been investing in real estate and stock market from last 7 years. I have done multiple courses in Canadian taxation, I understand the tax code, and even more importantly, I have seen patterns that most people miss because they're only looking at their own situation. So after filing many returns, I keep on seeing one system. You see what products are being pushed, who they are being pushed to, and most importantly, you see the results 5 to 10 to even 15 years later when people come back. And let me tell you, RRSP are the number one. They are the number one product I see being sold to the wrong people at the wrong time. Now, before the comments start blowing up, I'm not saying that RRSP are bad. They're actually powerful too, but they are like a power tool. In the right hands, it builds something amazing. In the wrong hands, you can seriously hurt yourself. So here's what we are covering today. First, I'm going to tell you about a client who came to me last month. Her story is going to blow your mind, and it's going to show you exactly what I'm talking about. Second, I'm going to show you a real math. We are going to run 3 scenarios with $100,000. Not $10,000 because I want you to actually see the actual impact over the 30 years. Third, I will break down the games that these banks are playing. I used to work at the TD Bank and why they incentivize to sell RRSP even when it doesn't make sense. And finally, I'll tell you exactly who RRSP are for. If you're watching this video, there's a good chance it is not for you. But first, let me tell you about my client. So about 5 months ago, right now it's October, so in June, a woman walks to my office. Let's call her Jana. So Jana is 29 years old. She moved to Canada 5 years ago, got her PR 3 years ago, and just landed her first 6-figure job, $105,000 a year. And she's absolutely crushing it. She sits down, hands me the box of documents and say, I need you to file my taxes. I start going through her stuff, T4, T5, pretty standard, and then I see RRSP, contribution receipt of $18,000. I'll be like, okay, cool, RRSP contribution, but something fell off. So I ask her, Jenna, do you have tax-free savings account? She looks at me confused. Yeah, I think so. But she said that my bank said RRSP is better because I get money back on my taxes. So I ask her that, how much is in your tax-free savings account? She pulls out her phone and then she checks the banking app and she told me, $4,500 in my tax-free savings account. So $18,000 in her RRSP, $4,500 in her tax-free savings account. She had $88,000 of tax-free savings account contribution room available. So I pull out my calculator, I always do, and show her what this mistake is going to cost her over the next 30 years. And the number I show her on my calculator, $127,391. Now again, I contact her after a few weeks. So before I show you how I calculate that huge number of $127,000, let me tell you what happened when she talked to her bank. So she asked her advisor, why did you put me on RRSP instead of maxing out my tax-free savings account first? The advisor said, well, you wanted the tax refund for your vacation, Jana. You remember that? Plus RRSP is for retirement, so it's a smart choice. So Jana told me about the situation and asked me, is he right? So what I told her next is exactly what I'm going to tell you. And trust me, once you see these numbers, you're never going to look at the RRSP the same way again. Alright, let's run the real numbers. And I'm going to use big numbers because I want you to feel the actual impact over the long term. Here's one scenario. And this applies to a lot of people watching this video. So a person, let's take age 30 years old, right? Income $100,000 per year and amount to invest $100,000. So maybe you've been saving from when you were 20 years old, maybe you have invested in Wealthsimple, $200,000. So time horizon, let's give it 30 years until retirement. Let's say you want to retire when you are 60 years old, all right? And expect to return 8% return annually. So that's S&P 500 average over the last 50 years. Now we are going to compare, this is really important, 3 different paths with this exact same $100,000. So path 1, you put all in an RRSP that probably your bank told you to do. Path 2, you're smart, you max your tax-free savings account first, what I tell most of my clients to do. Part 3, you put it in your regular non-registered investment account, and what most people don't even consider, honestly. So by the end of these calculations, one of these paths will leave you with $127,000 more than another path. Same starting amount, same time period, and same growth rate. The only difference is which account you choose at the age of 30. Let me show you. So let's start with year 1. So you're 30 years old, you take your $100,000 and you put it into your RRSP. What happens immediately? So let's say this is February going on, you put it in your RRSP account, your taxable income drops from $100,000 to 0 because you contributed $100,000, which is within 18% RRSP contribution limit. But actually, let's be more realistic. Let's say you contribute $20,000 per year for 5 years instead. And that's, I think, more realistic number. So year 1 impact income, let's say $100,000, RRSP contribution, let's say you contribute $20,000. That's a realistic RRSP contribution. So your new taxable income will be $100,000 minus $20,000. So that's $80,000. And approximately the client with that income get tax refund $6,200 depending on your province, and this varies with person to person. So you get $6,200 back. Sweet. Most people take this money, book a vacation, buy new furniture, upgrade their car, or they just spend it. Let's say you've been watching my YouTube channel and you've been disciplined. You don't spend it. You invest that $6,200 too. Now 30 years later, at the retirement age of 60 years, your $20,000 has been growing at 8% per year for 30 years. So that $20,000 at 8% for 30 years will be $201,250. Your $20,000 turned into over $200,000. But the catch here is that everyone forgets. When you take this money out at the retirement, the entire amount, all $200,000 is taxed at the regular income. Not capital gains, not dividend income, but just a regular income. So the same way your salary is taxed, let's say at retirement, you're at 35% tax bracket. That's realistic if you have pension income, if you have CPP, you have OAS and other savings. So the amount you will withdraw, let's say $200,000, tax or 35% at least. So that's $70,000 in taxes, and you actually keep only $130,000. But now let's take a best case scenario. You add the refund back. Now you have invested that $6,200 that you're getting, the refund back. It grew to $6,200 at 8% to 30 years. That's over $62,000. So now total amount you have is $130,000 plus $62,000. So approximately over $190,000. So $193,000 is your RRSP outcome after 30 years. So write that number down. I need you to show you the path 2. So tax-free savings account route, my favorite one. So year 1, the setup is same. So same scenario. Now you're 30 years old, you have $20,000 to invest, but this time you put it in your tax-free savings account. So what happens immediately? Nothing. No tax refund, no immediate gratification. And your bank advisor probably said, why would you do that? You're not getting anything back right now. But watch what happens. 30 years later, retirement at age of 60 years old, your $20,000 has been growing at 8% return per year for 30 years, same as RRSP. So that $20,000, again, 30 years at the 8% return, over $200,000. Same growth, same amount. But here's where it gets beautiful. When you withdraw this money at retirement, so the amount withdrawn will be $201,250. Your $20,000 turned into over $200,000. But the catch here is that everyone forgets. When you take this money out at the retirement, the entire amount, all $200,000 is taxed at the regular income. Not capital gains, not dividend income. So the same way your salary is taxed. Let's say at retirement, you're at 35% tax bracket. That's realistic if you have pension income, if you have CPP, you have OAS and other savings. So the amount you will withdraw, let's say $200,000, tax or 35% at least. So $70,000 amount you actually keep. So that's $70,000 in taxes, and you actually keep only $130,000. But now let's take a best case scenario. You add the refund back. Now you have invested that $6,200 that you're getting the refund back. It grew to $6,200 at 8% to 30 years. That's over $62,000. So now total amount you have is $130,000 plus $62,000. So approximately over $190,000. So $193,000 is your RRSP outcome after 30 years. So write that number down. I need you to show you the path 2. So tax-free savings account route, my favorite one. So year 1, the setup is same. So same scenario. Now you're 30 years old, you have $20,000 to invest, but this time you put it in your tax-free savings account. So what happens immediately? Nothing. No tax refund, no immediate gratification, and your bank advisor probably said, why would you do that? You're not getting anything back right now. But watch what happens. 30 years later, retirement at age of 60 years old, your $20,000 has been growing at 8% return per year for 30 years, same as RRSP. So that $20,000 again, 30 years at the 8% return, over $200,000. Same growth, same amount. But here's where it gets beautiful. When you withdraw this money at retirement, so the amount withdrawn will be $201,253. You know how much you will owe in taxes? $0. And the amount you keep? $201,253. Zero taxes, not a single penny to CRA. Now you might be thinking, that's for $127,000 you promised. And you're right, because we are not done yet. We are only looking at $20,000. Now let me show you what happens when we scale this up to full $100,000 investment over time. And then I'll show you your path 3, which will blow both of these out of water for many people. Let's say over 10 years, you invested $100,000 total, maybe $10,000 per year, that's realistic. $100,000 invested over time, growing at 8% return over 30 years with no contribution along the way. Future value approximately $1,006,000. And you're a millionaire, amazing. But at retirement, you withdraw at a tax rate of again 35%. So you pay $352,000 in tax. You keep $653,000 plus your tax refund. Over those 10 years, let's say you got $31,000 in tax refund. That's $31,000 invested over the remaining years grow to $248,000. So total $901,000. Same $100,000 invested over time. Same growth, future value $1,006,000. Tax at withdrawal, $0 again. So you keep your entire $1 million. So the tax-free savings account, you're keeping $1,006,000. And RRSP with refunds reinvested. And again, this is the best case scenario. Usually people don't do that. So with RRSP with tax refunds, that'll be $901,900. So the difference is $104,000. So over $100,000, same money invested, same time period, different account. So let's be more real. What if you didn't reinvest those tax refunds? But if you spend them like most people do? So RRSP without reinvesting refunds is $653,000, right? So the difference from tax-free savings account will be $350,000. So $350,000. This is what I showed Jana. This is why she was silent. And we haven't even talked about path 3 yet. So the path 3, non-registered savings account. Now let's say you have maxed out your tax-free savings account. You have more money to invest. Should you go to RRSP? And you know what? Your bank will say yes. But let me show you something else. Non-registered account path, same $100,000 invested over time, same 8% return, growth over 30 years, at a future value $1,006,000. But here's the big difference, capital gains treatment. When you sell at retirement, your cost basis $100,000, you gain $906,000. Only 50% of capital gains are taxable in Canada. So you only pay tax on $453,000. So tax at 35%, that's $158,000. So you keep $847,450. So the account you keep, tax-free savings account, is $1,006,000 and non-registered about $847,000. And RRSP with refund reinvested $901,000. And RRSP with refund spent that most people do, $654,000. So my point here is that most young professional tax-free savings account win by a huge difference. Even non-registered account beats RRSP if you're not disciplined enough to reinvest your refund. And here's what really hurts me. I have filed over 500 tax returns, and you know how many people I have seen actually reinvest their RRSP? And that number is out of 500 people. That's only 10.8%. So about 52 people out of 500 people. So if you're not on the top 10% of disciplined investor, RRSP is literally the worst choice you can make. So now we know if the math is this clear, why do banks push RRSP so hard? And after filing 500 returns, I'm talking to dozens of bank employees of the record. I've learned exactly how this game works. And the reason number one is sales quotas and commission. I had a client last year, Mike. Mike worked at one of the big 5 banks, and he told me that we have RRSP season from January to the March. If I don't open 50 new RRSP accounts, I don't hit my quarterly bonus. And nobody asked me if it's right for the client, they asked me how many I opened. So your financial advisor, they have a sales quotas. They're not asking what's best for you, they're asking how do I hit my number? Crazy, right? Reason number 2, the high fee trap. So here's what happens after they get you to open the RRSP, they recommended balanced growth fund or some generic mutual fund. That's crazy. I have seen about over 350 times that these funds charge management fees of 2% to 2.5% per year. And the administration fees is about 0.5% per year. Trading fees, that's hidden in the fine print. What's happening? Let's that sink in. You're paying 2.5% to 3% per year. And on that $100,000 investment, we talk about 8% return with 0.1% fees. That gives index fund is $1,006,000. And same exact 8% return with 2.5% fees that banks mutual fund usually do. That's $574,000. So you lost about $432,000 just in fees. So this $432,000, this is the amount not going to your retirement. That going into your bank pockets, bank profit margin. The reason number 3, the lifetime lock-in. When you have RRSP with them, they have got their hooks, let's say, on you. Buying your first home, they'll push you to use the home buyers plan, which means you come into the branch, which means they pitch you need a car, here's our auto loan, you want to transfer your RRSP to your lower fees, that'll be $150 transfer fee, plus we need 6 weeks to process it. And want to withdraw early for your emergency, 30% withholding tax immediately. I have seen my clients pay over $800 in fees just trying to escape their bank's RRSP. So this is game, and once you see it, you can't unsee it. So now let's talk about who should actually use RRSP. Now, I have been pretty hard on RRSP, I know, but here's the truth. They're not really that bad products. They're just sold to the wrong people at the wrong time. Out of my 500 clients, I have only noticed few people that make total sense that they open their RRSP. And if you are not in one of these 3 categories, then RRSP might not be right for you. So category number 1, employer matching. So if your employer, let's say, matches your RRSP contribution, kick it, period. I don't care what I just spent 80 minutes telling you. If they match, you contribute. But why? Because that's instant 100% return. You put $5,000, you have $10,000 immediately. And you just can't beat free money. Max out that employer match first, then go to tax-free savings account. Category 2, high income now, much lower rate later. So if you're making $150,000 right now, and you know you will make significantly less in retirement, the math can work. And my rule is tax-free savings account is maxed out first. You're earning $150K annually, you will reinvest the tax refund. You expect to drop at least 2 tax brackets in the retirement. And if all 4 of these things are true, then you can consider RRSP. So let me leave you with one rule that determines if RRSP will work for you. If you're not disciplined enough to reinvest 100% of your tax refunds every single year, don't use RRSP. And I'm serious. That tax refund you get, that's not free money. That's your money that you borrowed from your future self. Remember, RRSP with refund reinvested $901,000. RRSP with refund spent $653,000. And the difference is $248,000. So you need to be brutally honest with yourself right now. When you get $3,000 tax refund, do you immediately transfer it to your tax-free savings account or investment account? Or B, oh nice, extra money, and spend it on the trip, new phones, night out, hotels, or just life expenses? So if you answered B, tax-free savings account is your friend, max it out first. If you answered A, then you're on one of those three categories mentioned, then RRSP can work. But don't lie to yourself. I have seen many returns. I have seen how people play out, and only you know which person you really are. And I know that I have been doing this from last 2 years. I still see people getting sold RRSP when they shouldn't be. The system is designed to keep you confused, and the bank, they profit from your confusion. The more you don't know, the more they make. But you're here, you're watching this video, which means you're already ahead of most people. So what I want you to do is that log into your bank account right now, or log into your CRA, check your TFSA contribution room. If you have RRSP, find out what fees you're paying and call them, ask them about MER, management expense ratio. Look at your last 3 years tax refund. Did you reinvest them or spend them? And be honest. If your tax-free savings account room and you're under 35, consider redirecting future RRSP contribution to tax-free savings account. And do me a favor, if this video just saved you from making $100,000 mistake, hit that subscribe button. I post videos like this every week, breaking down the financial stuff that banks don't want you to understand. If you like this video, give this video a thumbs up and subscribe to my YouTube channel.